Hi, Melissa. How are you today?
Hey, good morning. Good morning. Glad to see you again.
Yes, yes. I'm Misty Cabanis, and welcome to my YouTube channel, Live, Earn, and Play in Central Florida. And I'm back with Melissa McGlinchey with Premier Mortgage. And we're going to talk today about closing costs and what you can expect at the closing table. Actually, so you can find out before you get to the closing table so you are not shocked. So you don't have sticker shock.
Yep. So we're going to go over kind of an estimated scenario, but break it down by line item for the different items that you would get charged on your closing statement for closing fees and what those items are. So
Okay.
I'll share my screen here in just a minute. And basically what I did was a scenario based upon a $350,000 purchase price with a loan amount of $280,000. So first and foremost, we look at what's called the loan to value, right? So 280,000 if that's the loan amount, and the value that we're going off of is the purchase price. That percentage would be 80% loan to value. So that's the scenario that we're going to be looking at today. So let me go ahead and share my screen so that we can take a
So
look
just
at
so
this.
people are understanding, that's putting 20% down.
Correct, correct.
Yes.
This
Mhm.
scenario is based on an estimate of putting 20% down.
Mhm.
That is correct. All right, let's see here.
And
All right, here we go. Can you see my screen?
I can.
Okay, so what I thought we'd do is kind of go over different line items, even if I don't have something here, if I feel that it's something that could pop up on a scenario, I'll kind of explain what it is. Okay. So the first thing I want to talk about here, which is very, very common right now, which used to not be common going back a year ago, is this loan discount points. So
Mhm.
loan discount points, biggest confusion here is the terminology. Okay. Discount points is when the buyer is paying points or paying a percentage of the loan amount to buy the rate down. So
Correct.
this is the buyer's choice, okay? Is a discount point and it buys the rate down. What's happening right now in this market, which is much different in prior years, and I've been doing this for over 25 years, is that just to get a rate right now, even for someone who has good credit, it's costing them, which never used to be the case. Okay.
Mhm.
And it's just because currently we are in a higher rate environment and the environment that's going on at the moment. So that's the reason why. So if you see in this area discount points, that means you're getting either charged for that rate or you're buying down the rate and you requested it. Sometimes, this is what I'm seeing a lot, is that when people are calling for quotes, the lenders immediately just, because people are going into sticker shock, they're immediately just putting points in here and giving them a rate, not explaining to them that they're actually paying this percentage. So let me give you an example. If it's costing 2 points for a rate, right? On this scenario, that's costing $5,600.
Mhm.
Okay. So about the average that I'm seeing is anywhere from 1 to 2 points right now that lenders are just automatically quoting without even explaining to the buyers that that's a fee for them to get that rate.
Yeah, and they're just
Okay,
adding it in as closing cost.
correct. Just adding
Mhm.
it as closing costs. Again, a good thing that could happen though is the seller could be paying, right, a percentage for you to buy the rate down, kind of giving
Mhm.
you that incentive. So that would go here under discount points. Okay. And then we would just say that the seller's paying it because the buyer is limited on how much money they can spend on this transaction. That got regulated back in 2015 and it was to protect the buyers. Okay. But right now, in a higher rate environment, it doesn't protect the buyers. So that's where the whole seller buying the rate down, okay, in this environment came into play, where sellers are now allowed to buy the rate down. It doesn't go against that percentage that the buyers are maxed out on spending. Hopefully, I explained that to where everybody understands. All right, let's go to the next one, admin fee. So almost every file is going to have either what's called an admin fee or an underwriting fee. Different lenders classify it different ways.
Mhm.
Okay. What we do for my company is we kind of group everything into an admin fee. Anything that we would charge, we put it kind of into one fee. But a lot of people will separate it out. They'll say, okay, listen, we're going to charge an underwriting fee of $9.95 instead of an admin fee. And then we're going to charge a processing fee and a doc prep fee. And basically they equate to almost the same amount. Okay.
Right.
But there's really no difference. When people look at admin fee or underwriting fee and they ask me, well, what's the difference between those? There's really isn't. It's just a matter of how the lender wants to classify the fee that they're charging.
Mhm.
And that's really all that it comes down to. Okay. I'm going to zap this out here.
And those are all typical fees. I mean, you know, we got to face it. It costs money to do business. It costs money to buy a house.
Correct.
Paperwork
Yeah.
costs money.
That is correct. That is correct. So anything in this top section, okay, are fees that have to do with the lender. Okay, either you're paying the fee to buy down the rate or it's a fee that the lender's charging. Extended rate lock fee. This happens a lot with new construction. Okay. Or rates drop and people really want to pay that extra amount just to keep it locked for 3 months. And then you get charged an extended rate lock fee. So that's what that could be right there. But other than that, you know, all of these fees, they're all going to the lender. Okay.
Mhm.
All right, let's go down to this next section that says services you can shop for. Little misleading, but it is what it is. So what I've got in here, and I'm going to zap these out after I explain them to you, because again, remember I said from our perspective, we group anything that we charge into one admin fee. However, I'm going to say about 95% of the companies out there, they have to pay. So the lenders themselves pay for flood certifications, pay for MERS fees, pay for tax service fees. So that's these 3 fees right here. Okay, tax service fees when we pay a company to monitor to make sure taxes are paid, flood certification that gets pulled on every single file. There are companies that will just break out those fees and charge the borrower for it. There's no right or wrong. Okay, it's not where if I was a buyer that I'd go back and say, oh, well, this company's not charging me a flood cert fee, but you're charging me a flood cert fee. It's getting charged somewhere. Okay,
Right,
we put
you
ours
just don't see it.
Right, we're putting ours in with the admin fee. But I did want to explain that if you see these 3 fees, every single lender within the United States pays these fees. Okay, so if they're not charging it to you and breaking it down line by line, that means they're putting it into their admin fee or they're putting it into their underwriting fee. Okay. All right, let's go up to the appraisal fee. So I've got 2 fees here that I want to explain. This appraisal fee right here, this is the one and only fee that buyers should expect that they have to pay up front during the loan process. Now, I always sidebar that with, hey, your realtor is going to tell you that you need to have a home inspection. Yeah. And buyers get confused between the home inspection and the appraisal.
Absolutely.
They are 2 separate items. The home inspection is not required for the loan. That's
Correct.
not and we don't even want to see it. Okay.
Right.
However, it's a phenomenal CYA. There could be something wrong with that home, right? That the buyer, in our eyes, we can't see, but that home inspector catches it. So you definitely want to have that home inspection. But from the loan side of it, okay, we don't look at that home inspection. So nothing on here that I'm going over will have anything about the home inspection on it. This appraisal is completely different. The appraisal is an appraiser goes out there and gives an estimate, does their own inspection. There's certain things for each program, conventional, FHA, VA, that the appraiser has to look at. Okay, so the appraiser has these guidelines of things that they need to look at, mainly structural integrity issues. Okay. And so that's what the appraiser is looking at. They're not going to get as detailed as that home inspector will. And the appraiser says, okay, well, according to other like homes that have sold within the past 6 months or the past year, if there's not enough sales within the past 6 months, here's the estimated value of your home. Now, this top fee that says appraisal final inspection, here's the reason why we disclose this on there. Let's say the appraiser goes out there, and I've had this a few times, the utilities or electricity is not turned on. the appraiser is mandated that they have to check water, they have to check electricity. And so if that's not turned on, and realtors know that needs to be turned on, okay? So when that happens, it's the realtor's fault because they need to make sure that that's turned on before the appraiser goes out there. So if the appraiser goes out and there's something wrong with them, I don't know, a hole in the wall, a broken window, okay? Those are kind of structural integrity issues that would have to get fixed. And the appraisal comes back in and says utilities weren't on, so I couldn't check. There's a broken window, okay? Those things have to get fixed. And then the appraiser has to go back out. Well, if the appraiser has to go back out there, guess what? They're charging a reinspection fee.
This is common with roofs. I actually just had this happen. So I said, let's just wait and schedule the appraisal till after the roof is on, because there's no sense in having him come back out there twice.
That is correct. If there's an issue with the roof, now, if there's an issue with the roof, that's one of the few times where we'd say, okay, show me a home inspection report that the roof has at least 3 years left of life left to it.
Yeah.
Okay. And so if there's a home inspection report or a roofer that's gone out and done an inspection on the roof, and it passes that inspection and has at least 3 years of life left, then we don't need to send the appraiser back out. So there's different things that can come about with that. However, if we don't disclose the possibility of this happening, the law states we as a lender have to eat that fee. Okay, so we have to over disclose, and that's what you're going to find on these estimates that are given, is if they're doing it right, they're over disclosing to protect themselves. Okay, but that's what that fee is.
That'd be a worst case scenario.
Correct. I'd say 99.9% of the buyers that I give estimates for come to closing with less money. I try to work it out that way, so this way they're happy at the end. All right, so this section in here is mainly all your title stuff, okay? Yes, you see the home inspection here, but it never ever gets disclosed on a statement, even at closing. All right. So lots of different things, and this comes from the title company. So once somebody goes under contract, we reach out to the title company and we say, hey, can you give us an estimate of your fees? Here's the purchase price, here's the loan amount. Can you give us an estimate for your fees? Every title company is different. Okay. So basically what I did here was I just kind of did an estimate for what they could expect. You're going to expect it's either a closing fee or a settlement fee. Exactly the same thing. Just depends upon how the title company classifies it. Okay. You've got your lender's title policy. Anytime that you obtain a mortgage, you've got to obtain title insurance. And this is the title company saying, here's what that title insurance will cost. Now, also a little sidebar here is the owner provides, or the seller provides owner's title insurance. Okay. On the first page of the closing statement, we can't do that on here. We're not a title company. So this is just an estimate of all the fees. We have to disclose the full cost of that lender's title policy. But when you go to closing, on the first page of the closing statement, you're going to receive a credit from the seller for the seller's owner's title. Okay, so the reality is that this lender's title policy right here is probably going to cost you somewhere between $350 to $450. Okay, but we have to disclose legally the full amount of the title policy. Not all sellers will give the credit. You know that. You can work that out in the, it's part of the contract, right? Of whether the seller pays that owner's title policy or not. But when it's a private sell and it's not coming from a builder, what, I'd say about 90%, 95%, Misty, the owners give a credit for the owner's title policy. When it's a builder, they hardly ever pay for owner's title policy.
Right.
All right. So that's these fees in here. And I'm going to go ahead and go down to the next section. This is county state fees, okay, for the county and the state. So we've got recording fees for the deed. We've got recording fees for the mortgage. There's different recording fees that will take place. I just broke it up on here just to show the two different types. It'll get grouped into one on their closing statement. So most of the time it's around $225 to $250, something like that. Every once in a while, if there's a lot of documents that are getting recorded, a lot of times that comes with condo complexes. I'll have that fee somewhere around 400. But for the most part, this is where that fee is going to end up for recording with the county. In the state of Florida, everybody pays intangible tax. And then if you get a mortgage, you're going to pay doc stamps on the mortgage from the buyer's perspective. The seller has doc stamps on the deed. It says state deed, state mortgage. We call those doc stamps, okay?
Mhm.
So seller pays doc stamps on the deed, buyers pay doc stamps on the mortgage. Again, 99% of the time, seller pays doc stamps on the deed, buyer pays doc stamps on the mortgage. If you're buying from a builder, guess what? Builders don't pay anything, right?
Mhm.
So the builder is going to charge the buyer for these doc stamps on the deed. That's also why you find the closing costs are higher, and then builders say, oh, but I'm going to give you this credit.
Exactly.
Right?
Mhm.
Yeah. It's
Yep.
because in a normal environment from a private sale, those sellers normally pay these items where the builders don't.
Yep.
Okay. All right. So we've got intangible tax and then we've got doc stamps on the mortgage. Let's go down. All right. So prepaids. This confuses a lot of people. You are not paying this in advance. Okay. All of these fees that we're going over, except for the appraisal, get paid at closing. The appraisal is the only fee that has to get paid up front because those appraisers will not go out to do the appraisal without being paid. Okay. That also took place from the recession time period. So appraisers need to be paid before they will actually go out and do those inspections. So a prepaid just means that it's a fee that gets paid up front right at closing for that period of time. So homeowners insurance, okay? Your home has to have insurance on day one of closing. So you've got to pay the whole 1-year premium at closing for your homeowners insurance.
You have
So
to have
I just
homeowners
estimated,
insurance. I just want to make sure that people understand that you're having, if you have a loan, you have to have homeowners insurance. That's a requirement.
yep, absolutely correct. And so I just did an estimate here of $1,800. Now, there are policies that come in much lower than that. There are policies that come in higher than that, right? There's a lot of variables regarding the homeowner's insurance, but that's where you would need to speak with an insurance agent when you're going to go under contract for a particular home and kind of get some estimates. Hey, what's a range that I should expect for this particular home? Okay. But I just used 1,800 here because that's a little bit on the high side for insurance policies. There are some that will come in higher, but that's kind of a safe area right now. Okay. Again, I like to overestimate. When I say it's on the high side, that means most of the policies right now are coming in around anywhere from 1,100 to 1,600 to 1,700 is most of our policies. Okay. Every once in a while, we get somebody that's a little bit higher than that.
Yeah, and that's determined
right.
also by county, especially here in Florida.
Yes. Yes.
Mhm.
Yep. All right. Daily interest. This is going to vary depending upon the day that you close. Okay. That's all that this is. So what happens is, let's just say that we were closing tomorrow, the 22nd. Okay. We would collect interest from the day of closing through the end of the month because your first payment isn't going to be until October 1st. You skip a month. And then when you pay your October 1st payment, you're actually paying interest for September. A lot of people don't realize that. When you make your loan payment, you're paying interest in arrears. So we're collecting interest from the day of closing through the end of that month, because when you make your first payment, that you then pay the next month's interest. Make sense?
Absolutely.
All right. Okay, let's go down to the area that confuses people the most. As if all of this
and the fun goes on.
Okay, so this is what we call an escrow account. All right. Now, when you put down less than 20%, okay, you are mandated these days where you need to have an escrow account. If you put down 20% or more, you get to choose, but you're still going to pay additional money. You're going to get charged a little bit higher of a rate if you don't do an escrow account, okay? And what an escrow account is it's saying, okay, in with your monthly payment, we're going to then take that homeowner's insurance policy. So let's go back up. So that homeowner's insurance policy was $1,800 for the year. That means it's $150 a month. So what we're going to do is we're going to add $150 a month in with your monthly payment, okay? And we're going to put that in a separate account. I like my internationals. They reference it as a savings account. It's your money. As a buyer, as the owner of the home, this is your money, and you get a separate statement on that escrow account every month, okay? I'm going to explain a little bit more in just a second, but property taxes are the only other thing that goes into that escrow account. So an escrow account is for homeowner's insurance and property taxes, okay? That's what you're putting into your escrow account on a monthly basis. And so I assumed property taxes here to be $3,600 for the year. Kind of an average, okay? Might be a little bit on the high side for some homes, but that would be $300 a month. So that again would be added in with your monthly payment, and that amount goes into this escrow account. So what happens every month is you get the statement. It will tell you what's in your escrow account. Once a year, those bills get paid, and your lender pays them for you, okay? You'll get a notice in the mail. It's not a bill. That's the other thing that confuses people is, oh, Melissa, I got this notice from for property taxes. I thought the mortgage company pays it. We do pay it. Okay. So that's a notification to you. It's not a bill. And it actually says at the very top, this is not a bill. It's just notifying you so that this way, you know, if your property taxes go up, guess what? Your loan payment's going to go up.
Right.
So you want to look at it. And you want to see, well, what were my property taxes last year? And then what are they this year? Did they go up? So I know whether my loan payment's going to go up or not. Okay. So that's
probably one of the most important parts right there. Everybody's going to want to know, as I like to say, sometimes tax tag and title out the door. What am I going to pay monthly? And that's how those monthly costs are calculated.
Correct. So what happens at closing is we have to set up this account. We're setting up your bank account. We're setting up your escrow account, right? And so we set it up with we collect 3 months of homeowners insurance and 3 months of property taxes. Look at this verbiage over here. It says hazard insurance. That confuses people. Hazard insurance is the exact same thing as homeowners insurance. It's just our legal terminology for it on the lending side. So we have to set up this account with 3 months of each so that this way there's always excess money in there. What happens next year? I mean, we've had this in Florida the last 2 years. Our homeowners insurance premiums keep going up because of the hurricanes. So we need to make sure that there's excess money in that escrow account to pay that bill when it comes due. Okay? So that's what that escrow account and the 3 months of each is for at closing. The other thing is a lot of times lenders will say, well, here's your closing costs and here's your prepaids because escrow and your 1-year insurance are separate. And they're a little misleading. Guess what? They all get paid at closing, all of it. Okay. So I tell people the full amount, everything together. Your closing fees plus your 1-year homeowners insurance plus setting up your escrow account. Here's the total funds that you should expect to pay at closing. And it's all of this group together. All right. One last section that we have down here. This is mainly for HOAs and for builders. Okay. That's what I use this last section for. I've got one builder that charges a 1.95% fee. So I've got this built in here just for that particular project. HOA capital contributions. If you're in a new complex, you've got to set up the budget for the HOA. So everyone's going to get charged an initial capital contribution to set up that budget. HOA setup fee. Sometimes there's transfer fees for HOAs. So different fees that HOAs can charge. You're going to see them in this section down here. That's the most common thing that comes into this area are your HOA fees. And those can vary tremendously anytime that there's an HOA. All right, so let's go down to this bottom area where we pull everything in together. Okay, if we take a look at this, where it says borrow paid closing costs. So on this particular transaction, you're looking that you should expect about, I like rounding up, so I'd say $9,700. Okay, so you've got a $350,000 purchase price. You should expect about $9,700 for your closing costs. That does not include any discount points to buy the rate down. Okay, So if there's any discount points, it's going to be added in addition to that. So a good rule of thumb, I always tell people, plan on 3 to 4% of your purchase price.
Yep,
Okay.
that was my that's where I was going next. I used 4%. Yeah.
Yeah, because if you plan for that, that's safe. 4%
Mhm.
safe.
Mhm.
Unless you're buying a specialty type product like an investment property, okay, or a condo hotel or something like that. But on a normal transaction, a single family home, a townhome, a regular condo that's warrantable, 4% is always a safe bet, because very rarely, unless the HOA has some astronomical fees, you're not going to be going over that 4% mark. You're going to be staying under the 4% mark.
Mhm.
And just like you, I just like to be safe. So this way, people, if you plan for worst case scenario, you're going to be just fine. Okay.
Absolutely.
All right. So that's your total closing costs there. And then this is saying, okay, based on this transaction, right, you're putting $70,000 down. This took into account anything that was paid up front or outside of closing. So this is saying your total cash to close is going to be about 80,000. Okay.
Mhm.
Very reasonable, very, good transaction for this type of purchase price. But all right, Misty, what questions can you think of from buyers I didn't go over? I do this a lot, so I tried to hit every question that buyers could possibly have when it comes to these fees. Probably the one I spend the most amount of time on is that escrow section.
Yeah. I see escrow, homeowners insurance. Those are the two ones. And again, they're property specific. So what I would just tell people is this is a great guideline. Thank you for breaking it down this way, and just give people an overall idea of behind the scenes kind of thing of what happens with your closing and how closing costs are calculated. Some people, they just want to know the out the door bottom, and some people want to know all of these fees and how it's compiled up, how they're all calculated up. So
Yeah.
and so, yeah, I would just say that this is just a great guideline that people can work off of. And Melissa, when we do these videos, we always talk people that, doesn't matter whether you're looking to buy a house 30 days, 60 days, 90 days, or later. These are the types of things. These are the reasons why you and I do these videos, so that people can start taking that time and watching these videos and asking questions based off of these, if they still have any questions, so that they can educate themselves, so they're much more prepared by the time we get to closing and when we get into the middle of the contract.
Yes. Yep. Absolutely. All right. Well, thank you once again for having me. And if anyone has any questions, please feel free to reach out to me, and I'd love to assist you.
All righty. Thanks, Melissa. I appreciate your time again today. And until the next time, and as always, I'll have both of our contact information on here where you can reach out to either one of us.
All right. Thank you so much. Have a fantastic day.
All right. Thanks. Thanks, Melissa.
Thanks.